And these guys are supposed to be the smart ones, but they were too dumb to see what I tweeted about 3 years ago. And again, I didn't tweet about it because I was so smart. It's just they were that dumb to have missed something so obvious. All the congressman had to do was just follow me on Twitter, right? And they would have known that those stress tests were bogus because I pointed out the elephant in the room, that they hadn't stressed for rising interest rates, rising inflation. I mean, certainly that was a possibility. I mean, I knew it was a certainty, but they should have at least acknowledged that it was possible. Of course, it happened, and it's going to happen even worse because the recession is going to get worse. Inflation is going to get higher. Long-term interest rates are going to spike. By the way, look at the yield curve. It is now uninverting. The yield on the 30-year is starting to move up. Things are starting to unravel. Slowly at first, it is going to pick up momentum. You can see it in the markets. I can see it in the gold market. Gold is that proverbial coiled spring right now. It was up about 15, 16 bucks today, maybe 1970. It's got higher lows. It goes above 2,000. It sells off, but it doesn't go back down as low. If you're trying to get the previous low, the market's not giving you that opportunity. The lows are getting higher. People are moving into gold. It is getting ready to explode to the upside. And you still have an opportunity to buy these gold stocks. You just can't be greedy and try to get a big dip because you're not getting a big dip. I mean, you're getting dips, but they're not big enough. They don't go down to the previous lows. You have to be willing to pay up to get these stocks. They're still giving you an opportunity to buy them, though. Take advantage of it, right? And I think the best way to do it is through me, my gold fund, Adrian Day, Europe Pacific Gold Fund. Buy the fund, or if you're a larger investor, set up a managed account in the gold strategy for us to manage for you at Europe Pacific Asset Management. But do it quickly because I think there's going to be an explosive up move in the gold stocks, in gold, a big drop in the dollar. Again, dollar index to me looks like it's getting ready to fall off a cliff. It's just this consolidation period. We're in a little bit of a no man's land. It's like the deer in the headlight. People haven't really come to terms with the gravity of what's about to happen. I know what's about to happen because I have been forecasting it for years. And by the way, I've had some people comment, and I read the comments, not all of them, but I look at the comments on the YouTube videos, and there's some people that seem to get annoyed by the fact that I say I told you so. I talk about stuff that I got right as if I'm just bragging about the stuff that I got right. There is a reason that I need to remind people of key things that I got right, like recognizing that these stress tests were bogus, recognizing that they should have tested for higher interest rates and inflation, which is exactly what this senator said the Fed should have done, except he didn't say it 3 years ago like I did. He waited for the higher interest rates to cause the problem that I predicted it would cause 3 years ago. But the reason I'm doing this is not because I just want to, blow my own horn. I think it's important for people to know this stuff that I got right. Because not everybody has been listening to my podcast for the last 10 years, right? It's like there are people that just started listening last week. They don't know. They hear me making a lot of bold predictions, and it's like, who the hell is this guy? How is he right? And they read a lot of stuff about, he's been gloom and doom for 10 years. He's a stop clock. Like, he doesn't know what he's talking about. So I got to point this stuff out because it's important that I have credibility about these bigger forecasts. Because if I remind people, if I point out all these little things along the way that I got right, and in the scheme of things, they're not really little. They're pretty big things that I got right, that so many other people either got completely wrong or they missed. It's important for people to have confidence that the other things that I am predicting now that haven't happened yet, that they will happen. They say, in the investment world, past performance is no guarantee of future results, right? Which, I guess is true. But if somebody has gotten a lot of stuff right, I think that person is more likely to get more stuff right than somebody who's got a lot of stuff wrong. Like if you're always wrong, what's the odds that you're suddenly going to be right? Whereas if you've been right about a lot of things, well, maybe you'll keep being right because maybe you're right because you actually get it. Maybe the reason that I got all this stuff right is because I actually understand the problem and how it's going to be resolved. And maybe the reason that so many other people have gotten so many things wrong and the reason they continue to get stuff wrong is because they don't understand. So I want to make it perfectly clear to people who are following me that I get this. And yeah, a lot of forecasts haven't come true yet, but they will because so many others already have. And the only thing about all this stuff that's happening that is shocking the hell out of everybody, right? The only thing that surprises me is that it took so long to happen. I'm not surprised by what's happening because I predicted what's happening for the precise reasons that it's happening. I didn't just grab stuff out of left field. When I talked about the problems that the banks were going to have with rising interest rates, I laid out exactly what those problems were. And remember that the mainstream conventional wisdom, right? Wisdom in quotes, about the banks and interest rates was that rising interest rates were going to be great for the banks. Oh, yeah, it's going to be great because they're going to be able to earn more money on their loans. They overlooked the elephant in the room, which was the loans they already made, how much they were going to lose. You know, I was doing a call this morning. It was a weekly call that we do with the team at Europe Pacific Asset Management. We discussed the strategy. I have all the portfolio managers on there with me, and we're talking about strategy and stuff. We do that once a week, and it came out in conversation that one of the guys got a 30-year mortgage. He bought his house here in Puerto Rico, actually, but he closed in like March, April of 2020. So right when interest rates were at their absolute low, he got a 30-year fixed rate mortgage at 2.88%. That's the lowest I've heard anybody get, 2.88%. Now, that is a huge win for him because for the next 30 years, he's got money at 2.88%. Again, think about First Bank in Puerto Rico that owns that mortgage. They're stuck collecting 2.88% for the next 30 years. That is a huge loss for that bank. Now, right now, it's not really, hurting them so much because they're still paying their depositors zero. I know because I've got money over there and I'm getting nothing, right? But, I don't want to put too much money there because I don't want to get nothing. I could leave my cash in my money market account at my brokerage account, right? And I'm getting, I don't know, over 4%, whatever it is. So I don't want to put a lot of money in my bank account. I want to have it in my money market, in my brokerage account. And more people are going to start yanking their money out of these banks. It's going to be a huge problem. But again, I was one of the only people for years talking about the flip side of these low mortgages. Everybody wanted to talk about how great it was that Americans were able to refinance and get all their mortgages down. And I kept saying, yeah, but what about the lenders? How horrible is it going to be for them when they're stuck with these loans? What is it going to do to their balance sheets when they're underwater in these mortgages? Well, we know it rendered them insolvent. But again, these hearings totally missed the point that one of the reasons that banks loaded up on these mortgages, government guaranteed, mortgages and treasuries, was because the regulators favored those investments. Because had they bought non-government debt, they would have had to take a haircut. They would have had to have marked their securities to market. But because they did what the regulators wanted them to do, they didn't have to have a haircut. They didn't have to mark to market. So because of these idiotic regulations that favored government debt over any other kind of debt, they said, hey, this debt is safe no matter what your maturity is. All you have to do is agree to hold it to maturity, no haircut, no mark to market. You can pretend you're solvent even when you're broke. And that's what happened. And now to say, oh, the solution is more regulations, the regulations caused the